All right, let's get straight to it. A huge warning signal just flashed from the Asian close, and it's aimed squarely at the US Open. Here's the deal. SK Hynix, a critical node in the semiconductor supply chain, just posted the biggest profit in its entire history. Sounds great, right? Well, while retail was cheering, the big money, the smart money, was selling, and I mean massively. We have to understand why, because the exact same logic is about to be applied to the US tech sector tonight. First, let's look at the headline number that fooled everyone. SK Hynix reported a profit of 47 trillion Korean won. That's about 35 billion US dollars. An absolutely staggering figure. Now, on the surface, this is the kind of news that screams, buy. It's what gets the headlines buzzing. But the real story, the one that matters, isn't in that number at all. Because while the good news was hitting the tape, the smart money did the exact opposite. Foreign institutional investors yanked over $1.4 billion out of the stock. Think about that. Record profits were met with a record sell-off. This isn't an accident, people. This is a deliberate, calculated signal. So the billion-dollar question is, what are their algorithms seeing that the rest of the market is completely missing? The answer? It lies in a framework that the really big institutions use to price everything. See, they don't just care about how good the numbers are right now. They care about the rate of change. And this is where we get into a pretty cool concept from calculus that literally drives billions in trading decisions, the second derivative. So what on earth is the second derivative of earnings? Well, it's not the profit number. It's not even how fast the profit is growing. It's the rate of change of that growth rate. In simple terms, is the company's growth speeding up or is it slowing down? Is it accelerating or decelerating? This is the secret metric they use to spot a trend reversal before anyone else even sees it coming. I love this analogy because it makes it so clear. Think of SK Hynix as a supercar. That massive profit number, that's its velocity. It's blazing down the highway at 200 kilometers per hour. It's incredibly fast, no doubt, but if it can't go any faster next quarter, its acceleration has just hit zero. And this is the absolute key. The market, the smart money, doesn't pay for speed, it pays for acceleration. And here's the rule that governs all of this. This is the law of the land for growth investing. Markets will pay an insane premium for positive acceleration. But the second that acceleration tops out, the moment it hits zero, the stock's valuation multiple starts to shrink. The price will fall, even while the company is still reporting record profits. This is the peak earnings trap, and the big funds just sprang it on SK Hynix. Okay, so if the big players just pulled billions out of a top semiconductor company, where'd the money go, right? Capital never just vanishes into thin air. It rotates. And by tracing that flow, we can see exactly where the smart money is placing its next big bet. Let's follow the trail. Now, when you look at a market map like this, it can be incredibly deceptive. You see SK Hynix closed up on the day, it's green, and you might think, hey, everything's fine. This is what we call surface noise. It's a trap. The real signal, the alpha, is never in the daily closing price. It's in the huge volume of foreign capital that was quietly heading for the exits. That flow is the only thing that matters for what's coming next. And here you have it. The money trail laid bare. That $1.4 billion rotated with military precision. We saw immediate signal activation in two very specific sectors, physical security and energy. Specifically, capital flooded into Hanwha Ocean, a major defense shipbuilder, and Doosan Enerbility, a key player in nuclear power. This isn't random. It's a clear tactical pivot from bits and bytes to steel and concrete. Okay, so why do you, trading the US market, need to care about a capital rotation in Seoul? Because this isn't some isolated local event. This is a leading indicator. What happens in the Asian supply chain is often the canary in the coal mine for US tech. We need to translate this signal into an actionable plan for our assets. This image just says it all, doesn't it? We are witnessing a textbook risk-off rotation. The smart money is cashing out of digital growth, symbolized here by a high flyer like Nvidia, and moving into the safety of physical security, like defense contractor Lockheed Martin. They're swapping high-risk, high-growth tech for the safety of defensive, hard asset industries. So let's make this crystal clear. The implication here is direct and unavoidable. The signal coming out of Seoul is bearish for the main US semiconductor ETF, the SOXX. We should fully expect this Hynix shock to ripple across the Pacific and put real pressure on names like Nvidia and Micron the moment the US market opens.
All right, analysis is useless without a plan. So let's pivot from the why to the what to do now. Here is your tactical briefing for tonight's US session. Tonight's wildcard is Apple's earnings. The market's already expecting big things, so the real story is going to be in their future guidance, especially what they say about China. There are two ways this can go. Scenario A, they guide strong on AI, and the Nasdaq finds some support. But scenario B, a miss in China, that would confirm everything we just saw with Hynix. It would validate this peak global demand narrative and could spark a much wider tech sell-off.
So here's your action checklist. It's simple. For NASDAQ futures, the number to watch is 25,850. That's your line in the sand. If we break below it, your order is to hedge or get short to protect your portfolio. On the flip side, for the defense sector, if it opens strong, you buy. You follow the capital flow that started in Asia. Simple as that. And let me be absolutely clear about this. A break of 25,850 isn't just a minor dip. That's a break of the entire weekly trend structure. If that level goes, the next logical target for the bears is all the way down at 25,500. You need to be prepared for that possibility. So we're going to end right where we started. The market doesn't pay for speed, it pays for acceleration. The signal from one of the most important supply chain nodes in the world is that acceleration has now peaked. So the only question left to ask is the one you need to answer for yourself. Is your portfolio positioned for the deceleration that's coming next?